Did you know that owning just one share of a company makes you part owner of that business? Yes, you heard that right. Today, we're diving into the world of stocks and how they can help you build wealth over time. Let's start with a simple question. Have you ever wondered how people grow their money without working extra hours? The answer often lies in investing in stocks. But I get it. Stocks can seem confusing, risky, and downright overwhelming. That's why I'm here to break it all down for you. So, what exactly are stocks? A stock represents ownership in a company. When you buy a stock, you're essentially purchasing a tiny slice of that business, known as a share. Companies issue stocks to raise money, and in return, shareholders get a claim on the company's profits. Sounds pretty cool, right? Now, let's talk about why people invest in stocks. The number one reason is growth. Historically, the stock market has delivered higher returns compared to other investment options like bonds or savings accounts. Over the long term, stocks have averaged about 7 to 10% annual returns after inflation. But here's the catch. Stocks can be volatile. Their value can go up or down in the short term, which brings us to our next point. One common fear is the risk of losing money. And yes, it's true. Stocks come with risks. But not all risks are created equal. The key to minimizing risk is understanding what you're investing in. There are two main types of stocks: common stocks and preferred stocks. Common stocks are what most people think of when they hear the word stocks. They give you voting rights in the company and the potential to earn dividends. Preferred stocks, on the other hand, don't usually come with voting rights but often offer fixed dividends. Think of it like this. Common stocks are like playing offense, aiming for higher growth, while preferred stocks are like defense, focusing on steady income. Okay, let's address another big question. How do you actually make money with stocks? There are two main ways. The first is capital gains. This happens when you sell a stock for more than you paid for it. For example, if you bought a share for $50 and later sold it for $70, you've made a $20 profit. The second way is through dividends. Dividends are a portion of a company's profits that are distributed to shareholders. Not all companies pay dividends, but those that do often provide a steady income stream. Now let's talk about how to choose the right stocks. The stock market has thousands of companies, so how do you decide where to put your money? It all starts with research. Look at a company's financial health, its leadership team, and its growth potential. Ask yourself, is this a business I believe in? Do I think it will grow in the future? But here's the thing. Picking individual stocks isn't for everyone. It takes time, effort, and a lot of learning. If you're just starting out, consider investing in index funds or exchange-traded funds, also known as ETFs. These are collections of stocks that mirror the performance of a specific market index, like the S&P 500. They're a great way to diversify your investments and reduce risk. Speaking of diversification, let's talk about why it's important. Diversification means spreading your investments across different assets to reduce risk. Think of it like this. You don't want to put all your eggs in one basket. By owning a mix of stocks from different industries, you can protect your portfolio from big losses if one sector takes a hit. Another key factor to consider is your investment timeline. Stocks are best for long-term goals. If you're investing for something 5, 10, or 20 years down the line, like retirement or your child's college fund, stocks can be a powerful tool. But if you need the money in a year or two, stocks might not be the best choice due to their short-term volatility. Let's talk about another crucial aspect of investing: emotions. The stock market can be a roller coaster. Prices go up, prices go down, and it's easy to panic. But successful investing requires discipline and a long-term mindset. Don't let fear or greed drive your decisions. Instead, stick to your investment plan and focus on your goals. Now, let's address some common misconceptions about stocks. One myth is that you need a lot of money to start investing. The truth? You can start with as little as $1. Many platforms now offer fractional shares, allowing you to invest in big companies like Apple or Amazon with just a small amount of money. Another misconception is that you need to be an expert to invest. While knowledge is important, you don't need to have a degree in finance to get started. The key is to start small, learn as you go, and stay consistent. So how do you actually start investing in stocks? First, you'll need to open a brokerage account. This is like a bank account for your investments. There are plenty of online platforms to choose from, so look for one with low fees and a user-friendly interface. Once your account is set up, you can deposit money and start buying stocks. Remember, investing isn't about timing the market. It's about time in the market. The sooner you start, the more time your money has to grow through the power of compounding. Compounding is when your investments earn returns, and those returns start earning returns themselves. Over time, this can lead to exponential growth. Before we wrap up, let's talk about the importance of staying informed. The stock market is constantly changing, and staying updated on market trends, economic news, and company performance can help you make better decisions. But don't get caught up in daily market swings. Focus on the big picture and your long-term goals. If you're ready to start investing in stocks, take the first step today. Do your research, set your goals, and make a plan. And remember, the most important thing is to start. Every great investor was once a beginner. Now I want to hear from you. What's one stock or company you're interested in? Share it in the comments below. And if you found this video helpful, don't forget to hit the like button and subscribe to our channel. We post new videos every week to help you master your money and build wealth for the future. Let's make your financial dreams a reality. But let's dive deeper into the history of stocks and why they've been such a powerful wealth-building tool for centuries. Stocks have their origins in the 1600s with the creation of the Dutch East India Company, the first publicly traded company. Back then, merchants pooled their resources to fund long voyages, sharing in the profits and risks. Fast forward to today, and the same principles of shared ownership and potential growth still apply, just on a much larger scale. Another layer to stocks is understanding the sectors of the market. The stock market is divided into sectors such as technology, healthcare, finance, and energy. Diversifying across these sectors can further reduce your risk. For example, while the technology sector might face volatility during certain economic downturns, the healthcare sector might remain stable due to constant demand. Let's also talk about the concept of blue-chip stocks. These are shares in large, well-established companies with a history of reliable performance, like Coca-Cola, Microsoft, or Johnson & Johnson. They might not offer the explosive growth of smaller companies, but they provide stability and steady returns. Blue-chip stocks are often a cornerstone of a strong investment portfolio. And for those who want to get even more strategic, there's value investing versus growth investing. Value investors look for stocks they believe are undervalued by the market, while growth investors focus on companies with high potential for future expansion. Both strategies have their pros and cons, and many investors choose a blend of the two. One more tip: don't forget about dividends. Dividends can be reinvested to buy more shares, a process known as a dividend reinvestment plan, or DRIP. Over time, this can significantly accelerate your portfolio's growth, thanks to the power of compounding. Finally, let's discuss the psychological aspect of investing. Fear and greed are two emotions that can wreak havoc on your portfolio if left unchecked. During market downturns, it's natural to feel scared and want to sell, but this is often the worst time to exit the market. On the flip side, during market booms, greed can push you to take on unnecessary risks. Having a clear investment plan and sticking to it can help you avoid these emotional traps. Investing in stocks is more than just numbers. It's about creating opportunities for yourself and your family. Whether it's funding your retirement, buying your dream home, or leaving a legacy for the next generation, the choices you make today can shape your financial future. So, are you ready to take the leap? Start small, stay informed, and remember, every expert investor was once a beginner. Let's build wealth together, one stock at a time.